here is the presentation on the macro side. Especially, I think it's relevant to speak about the labor markets numbers that came out today, which I think confirm further cracks in labor markets. We're starting to see a trend here of weakening labor data over the prior weeks. And I put this chart together because in June 28th, the University of Michigan also came out with their long-term inflation expectation number that you can see in the white in the slide, in this chart. You can see inflation expectation has been rising significantly over the last years. In fact, it was the largest print that we've had since the 80s, I believe. And on the red line, you can see the economic surprise continues to actually surprise on the downside. For those that don't know what the red line really is, it's just looking at actual data relative to what was estimated. And the data is coming significantly worse than what was estimated. Therefore, this red line continues to dip lower. And so this is a classic stagflationary type of chart in which puts the Fed in a very difficult position. It has to pick between their dual mandate of inflation stability and labor market stability. As we see economic data weakening, I would suspect that the Fed is going to pull the card of the economic weakening and therefore actually starting to ease their monetary conditions. And the main reason for my view on that is because of the interest payment on the debt, that it continues to surge as we see interest rates remaining higher for longer. And so that to me will more and more become a relevant part of monetary policy as we move forward. So let's go to the next slide, in which this next slide, you can see the cross-asset volatility that is historically suppressed. I mean, I can't recall in my career at least a few times that we've had a periods like this, and those are usually sort of the calm before the storm types of environments. And you can see here on the top one, you're looking at credit spreads. So you're looking at what's the difference between corporate bond yields versus the treasury market. And you can see clearly you're not receiving much of a premium for taking additional risk in the market of corporate bonds. The second one is looking at VIX. You can see VIX for equity market volatility has been also historically suppressed. The third one is looking at FX volatility, completely different asset class. And you can see here as well that it's also certainly historically suppressed. And the fourth one is oil, in which has been sort of moving higher recently, but volatility has also been very low. I would suspect that volatility will pick up significantly, and the main reason for that is now I'll develop it here in the next few charts, but let's go to the next one. And so you can see in this one that despite the fact that volatility across all these asset classes are low, the bond market volatility remains high. That's the red line. So you're looking at the MOVE index. It's a Bank of America index for looking at the bond volatility, particularly in the treasury market. And you can see that there's a divergence between the two. And the divergence is not from, the prior month or the prior 2 months. It's been the case for a while. We've seen this weakening liquidity in treasury markets caused by many reasons. I would perhaps say a few of them. One of them being the central banks have been participating less and less in the treasury market relative to the amount of issuances, and obviously the amount of spending we've had here in terms of the government fiscal stimulus that has been creating this flood of issuances of treasuries, creating as well an increase in volatility. And I would suspect that this volatility in the bond market would eventually actually cause further volatility as well in other parts of those other asset classes. So I think that's those other cross-asset volatility is poised to increase as we see bond volatility staying higher for longer. Let's go to the next chart. And you can see sort of this index is the U.S. Government Securities Liquidity Index, shows as well that liquidity has been poor in the treasury market, which supports the idea that the bond volatility should also stay higher for longer. And at some point, we start to see this sort of infiltrate other parts of the economy. As interest rates stay higher, you start seeing other businesses and even the government start rolling down their debt. And as we see that occurring, it should actually also increase the risk for defaults and other things. In fact, if we go to the next chart, let's go here. It's interesting, the fact that sometimes we think about it, well, but we've seen this hiking cycle by the Fed. Is it normal to see the volatility suppression like that? Like have we seen this in the past? And that's the idea of this chart specifically. So it's looking at basically a measurement of volatility or measurement of complacency, looking at the credit spreads in the first panel of this chart. So low means complacency is high. And below, in the second panel, you can see the Fed funds rate, which shows that we've been in an interest rate hike cycle recently. And as you can see here, it's very normal to see, as we see the hiking cycle progress, volatility tends to be suppressed, and then there's a lagging effect that ultimately actually causes volatility to explode to the upside. I think we're at the final moment of this, and we're starting to see this probably starting to show signs that we're going to see an increase of volatility that will also most likely also impact the credit spreads to widen significantly. Let's go to the next chart, because if you see here, there's a number of bankruptcies starting to pick up, and this chart is basically looking at the number of filings of bankruptcies on the very top of the chart, and you can see here in blue bars is so far year to date relative to prior years. It's not a huge increase in that basis, but we're seeing that the rest of the year it hasn't really picked up at that front. But in the filings by month, you can see that with more granularity, you can see that they're starting to pick up significantly over the last years here relative to 2020, when we had the COVID recession. We saw a print of 74 filings by month, and now we're at 69, 62. So clearly the trend is higher in bankruptcies. And if you dive in further in the next chart, you can see it that by sector, consumer discretionary is the one that is really driving this. Consumer discretionary, if you know, the consumption is a huge part of the economy in the U.S., but not only that, consumer discretionary businesses have never been so levered. So when we calculate in our own models amount of debt in the system in the consumer discretionary sector of the market, it is the most levered it has ever been. And so it makes sense that we're seeing bankruptcy filings actually increase, mostly being caused by that part of the market, because those are the companies starting to roll over the debt and starting to see that increase of interest rates having an impact on how they service that debt moving forward. And so we're seeing those bankruptcies come on the back of those of this macro backdrop that we're seeing. Let's go to the next chart now. And so what we have here, this next one is, to me, perhaps maybe the chart of the week, which is basically looking at the number of stocks that are beating the S&P 500 on a percentage basis, and which is the lowest number we've seen since 1974. This speaks volumes about the breadth of the market. I mean, the breadth of the market has been weakening, as we all know. There's many measurements we can see on the front, even the percentage of stocks that are above the 200-day moving average in different indices, not only NASDAQ, but also the S&P 500, Russell 3000, you name it. All indices, broadly or less broadly speaking, are showing weakness in the breadth of the overall equity market, in which it shows that the lack of leadership will eventually give in. And as we see that, likely very similar to what we saw back in the early 2000s too, when we've had that lack of leadership eventually causing the market to weaken significantly, and so showing large fragility as in the overall market. Let's go to the next chart. And so what is one of perhaps the most important thing happening this week, in my view, was this breakout on the 2 versus 30s, or the yield curve has been basically steepening recently. As you can see, there was a support, or I should say a resistance line that recently was broken, and the yield curve has been steepening recently, perhaps because of some of the situation with the debates and some of the changes in markets in terms of the likelihood of who is going to win in elections. But really, in my view, it a lot more than that. It has to do that this steepening of the yield curve is the recession signal. I mean, it's the fact that we're seeing a very inverted yield curve, that we're now an inversion process, or the steepening process that we see, is usually a sign, or I should say, it's often, and I don't think it has that. I mean, every time we've seen an inversion to the degree that we've seen so far, and then a steepening move, every time has actually caused a recession. And so what we're likely to see, however, is that the steepening of the yield curve can also be seen as a healthy environment. So be aware of the analysts, the wave of analysts that are likely to come out to speak very positively about this development. And I would say that this is a very strong and reliable recession signal. So I'm paying very close attention to this. I think we're just at the beginning of an acceleration to the upside of the yield curve. And let's go to the next chart, because I break down a little bit of what this really means. Is an inflationary bear steepener. We're seeing on the front end a decline of the 3-year. This is actually in 1973-74, a stagflationary environment, when we saw a decline of the 3-month year or the short-term rates. We saw an increase on the 10-year, and that was really causing the yield curve to actually steepen significantly. I think this is very similar, and perhaps even more pronounced on the 10-year increase, because of the flood of issuances that we're seeing as well. So this is another way of really measuring how much inflation is in the system, is actually paying close attention to the yield curve and the shape of the yield curve, but also what's causing the yield curve to move. And this is a bear steepener that we're seeing recently, outside of today, that actually has been being really forced by this pressure on the upside of the 10-year yields and 30-year yields and other long end of the curve. Let's go to the next chart. This next chart, in line with the same upward movement in the yield curve, we're seeing oil also break out. This is also another inflation trend that I think is just starting. A lot of people were suspecting that we would see oil decline as we had the recession, I should say elections coming up, because usually you tend to see some political moves towards trying to avoid oil prices to increase. My view is that there is almost no president, perhaps, you can point to that have that much of an involvement on impacting oil prices lower. In fact, I think that this is very likely to see an acceleration to the upside in oil prices that will put the Fed in a very difficult position. In fact, the weakness in inflation numbers we've had recently are actually on the back of low energy prices. And I think that this is changing the picture quite a lot, because energy prices could actually be breaking out to the upside in a big way as we see this chart developing forward. Let's go to the next chart. I'm almost done here, guys. You can see here, Japanese yen is starting to diverge from the interest rate differential. The point of this chart is that the white line is looking at the Japanese yen depreciating. So the higher the white line goes, the lower, the further the depreciation of the Japanese yen versus the dollar. And it's starting to diverge from an interest rate differential, meaning the 10-year yield in Japan is actually moving faster than in a higher way than the U.S. 10-year yield. And therefore, we're seeing the differential between those two yields is starting to diverge. And that really shows me that the Japanese yen is starting to get ahead of itself, I should say, or the dollar yen is getting ahead of itself the other way around. And I would suspect that the Japanese yen could be trying to find a bottom here. I know this is a very contrarian opinion. In fact, if you go to the next chart, you can kind of see that the positioning on the futures market is also very extreme. It's near record positions of people betting that the Japanese yen will continue to fall. So basically what I think is happening is this is not just a case with the Japanese yen. It's happening across many other dollar pair or FX. pairs, in which I think the dollar is actually, I would suspect that the dollar would have been a lot stronger on the back of such a strong interest rate differential, one of the strongest interest rate differentials we've seen in history, particularly in the short end. I mean, what the Fed has done so far with raising interest rates relative to other countries, you would suspect that capital would be flowing even more back into the dollar, and we're not seeing that. And to me, that's a very bearish environment for the U.S. dollar. In fact, if you go to the next chart, not only the Japanese yen is in near record bearish positions, but the Canadian dollar is also looking like a very crowded opinion of most investors and speculators by shorting the Canadian dollar. And this is what creates and sets the stage for a big change in particularly in a short squeeze, right? You have all these people shorting one currency, and then it gives all this room for a shift of opinion and stance. That once that happens, you tend to see a surge of the instrument, and I think the Canadian dollar could see certainly a further appreciation from here. Let's go to the next chart. And so a few things. The U.S. trade balance is probably one of the most important things going on too as well that I would point out. We've seen this downward trend of trade balance. The trade balance is a significant thing because it may seem irrelevant, but when you're running a fiscal deficit of over 6%, and on top of it, you're also running a 4% trade balance deficit, it adds to about 10%, which is the next chart, and it shows the U.S. Twin deficit issue that includes the current account and the fiscal deficit relative to GDP, where the U.S. is structurally running a very negative twin deficit relative to GDP, which is below what we saw in the tech bust, and now not too far from the global financial crisis. And I think that's what creates also a very bearish environment for the dollar and very positive for hard assets. I have a very strong view that this is one of the most important charts for investors over the long term, is this structural problem of the twin deficits relative to GDP. And a lot of people who look at this chart said, but this is a normal thing to see when you are at the reserve currency. Yes, it's normal to run a certain degree of a deficit, but not a 10%, a double-digit deficit relative to GDP. This is a real problem for the U.S. Let's go to the next chart. And most importantly, because it doesn't really matter the governance, what we're seeing is government expenditures relative to GDP, excluding the payments or what they receive from taxes. We're seeing 44% of GDP today, which is as high as it was at the World War II. And you can see the upward trend of this level of a lack of discipline on the fiscal side. In fact, in the next chart, as you can see, we try to get sometimes political and blame one party versus another, but really both parties have been very negative when it comes to the stance of the deficit. I mean, the stance of the deficit has been bad in both parties. In fact, it's very similar to what we saw back in the 40s during the World War II in terms of what we're running of deficits. And I think this is going to be more and more of a problem and more of a discussion as we see perhaps even a Bank of England moment in the 10-year yield and a spike of the 10-year yield with elections and this sort of lack of work towards fixing the fiscal problem here. And I think this is becoming more and more relevant as well of an issue. Let's go to the next chart. I think I'm going to close up. I think, look, gold is consolidating, showing a chart of gold. Gold has been consolidating after a breakout from a triple top. I love this chart of gold because I'm seeing that the dollar is just so it's just not moving despite the positive environment for interest rate differentials and other things that I think it should be moving on. And gold has been consolidating at that phase, and I think we're getting ready for another big move. But I would like to close out. I think the next chart, let's see, I believe it's looking at this chart that I think is such an important aspect. I think there's one of the most historically unsupported views of the market today is this idea that the gold miners or gold itself can go a lot higher. However, the miners are not going to follow. And this to me is just a a usual sign of a narrative that has been imposed by market participants that have not either participated in prior bull markets of the mining industry, or just because we haven't seen one for a long time, people have forgotten that when metal prices go a lot higher, we tend to see the gold miners starting to fundamentally improve. And that's certainly what we're seeing in the industry overall. Now, technically speaking, from a technical perspective, you can see in this chart, there's nothing like seeing higher lows in the chart, seeing what these businesses sell is gold, and gold prices are higher, already broke out to new highs. To me, this is the perfect setup that we're seeing here. And I would like to remind you of a phrase from Senzel, in which we had the opportunity to meet with him once, and I'll close up my presentation here with that. But essentially, I think Senzel made a really good point about where great money is made. Great money is made on where there is lack of liquidity and interest of capital into a certain business or industry or sector of the economy, and not the other way around. When there are crowded positions and folks are conventionally speaking about certain subject like AI or technology in a big way, those markets tend to be highly efficient. It's very difficult to make great money. And so this is a type of industry in which there is certainly a very large number of investors that are extremely bearish. And when you think about the potential for those folks to change their stance to become more positive and actually drive prices significantly higher, is to me where the opportunity really lies ahead. So I think this is a chart that shows the significance of why we've been investing in the mining space for so long here, in our view about how this is really poised for a major breakout. And if that happens, I think it's going to accelerate the entire industry to the upside in a significant way, and a lot of positive developments will probably occur in this part of the market. So